Okay, on to learning objective 4. We already talked about how partnerships are flow through entities, and that means each partner just gets a percentage share of the profits allocated to him or her, and then they pay the tax that income creates on their own personal tax returns. And the partnership doesn't pay tax. So now we're going to deal with how to actually affect that, how to make that happen. And the main thing we have to get in doing that is that you can't just take the bottom line profit number, taxable income number from a partnership, and allocate it, say, 33% to each of three partners, because there are components of that taxable income number that the partner needs to know about specifically. So it can't just be one number allocated. So we have to look at a bunch of different things called separately stated items. These are items that the partnership has to know, or the partner, sorry, has to know about, so that when they go to do their own tax returns, they can account for those individual pieces of the partnership's taxable income accordingly. So what you do is you start off with taxable income of the company, or we call it ordinary income. You back out all of these. Oh, I should know. I'm sorry. Let me back up. You start off with taxable income of the partnership. You back out all of these separately stated items, and then you arrive at just the ordinary income of the partnership. That amount can be split into whatever profit sharing percentages exist out there. 33% in our most recent example with Sarah and Chance and Nicole. Those separately stated items then that need to individually be allocated to the partners based on their profit sharing percentages, or based on whatever situation is applicable to those particular items. So let's look at it a little bit closer. There's a bunch of common separately stated items, and there's even more than this, but for the most part, it's just investment type income items and certain kinds of deductions that get separately stated to partners. And look at this big example. This is taking us back to Nicole and Sarah and Chance and their 1/3 ownership in CCS. In this example up here, they give us this situation that says their '09 net loss overall was $80,000. That's like the taxable loss. But there were some dividends and short-term capital gains, and this $20,000 amount that was for Sarah's capital interest. So what they have to do is break out these amounts that have to be separately allocated to the three shareholders. So they take these all out of the income and get to this ordinary business income, and that gets split 1/3 each. Then the separately stated items, these three things we took out, the separately stated items are allocated according to whatever logic goes on for those items. The dividends and the gains, those are still 1/3 each, but dividends need to be separately stated to partners because they have to put them on Schedule B on their 1040. They go in a special spot. If those numbers were just baked into these numbers, the partner would never know where to put, would never even know that dividends existed inside of this number. Short-term capital gains also, those go on Schedule D of a 1040. Again, the partner would never know if they were just buried in these numbers here. And then the ordinary income to Sarah and the deductions to these two partners, they get separately reported to each party accordingly. So that's the basic idea of breaking out separately stated items. You're going to have to do that on your partnership tax return, and that's really all I can say about that for now. I'll take any questions that you have on this topic. Last thing I wanted to briefly mention, guaranteed payments are kind of an odd situation. They are like wages paid to a partner in a partnership, and they get treated kind of like that too. So read through the section on guaranteed payments. These are amounts that will be allocated specifically to the person receiving the payments, the partner receiving the payments, and will be income to that person, and they will be deductions allocated to or of the partnership, and they will get allocated to all the partners accordingly, according to their profit sharing percentage. So guaranteed payments are something that you should read about a little bit. Good examples here that deal with the whole process of figuring out ordinary income and then allocating separately stated items to individual partners.